How's it going, guys? Welcome back to mentfx and welcome to kind of the second parter to the previous video released. So if you haven't seen it yet, make sure you check it out. It's called Mitigation. And in this one, it'll be a substrata of the mitigation, a continuation of that video. And we're going to get a little bit deeper into understanding specifically how mitigation is used in formulating a trading plan and formulating an entire strategy that you can follow to become profitable. So as you guys understand, and as per the last video, mitigation is the reduction of risk in a specific zone after manipulation on behalf of smart money. And the way it often looks is you will have a zone that got pushed down to continue in a given direction. And upon that zone being pushed down to continue, there was orders that were left untraded into or unclosed by this inefficiency, which again, inefficiencies exist everywhere and they help you understand where exactly these pushes occurred that may in the future have mitigation. And when that mitigation occurs, aka when price comes into that area, it has one of two things that it's there to do. One, it's either there to mitigate and to reaccumulate to continue a bullish structural push, or two, it's there to mitigate, redistribute, and continue a push downwards. Oftentimes, you'll be able to tell which one it is going to be by studying the type of confirmation found within that price action. Now, similarly, as price comes into this deeper area, it has one of two things it can do. One, it can either accumulate from that point and after the mitigation and continue to the top side, liquidating new structure, or two, it can continue trading deeper. So how do we understand when we want to use certain zones and when we don't? Well, relatively simply, as I've always said, as I've rang true, as many other YouTubers that have now started their channels as a result of mine have sometimes told you guys, there are three main steps. And I don't care what you really call them, but the three main steps is to have a structural formation to understand where you are in structure. Two is to have an S&D point. This is how I teach. Other people call it POIs. I do sometimes as well. Some people call it AOIs. Some people call it some other stuff. I have no idea, but in reality, this is all it is. And three is the confirmation, which is oftentimes in the form of Wyckoff. So we've been teaching this forever. You guys should know this by now because so many YouTubers have now taken this and made it into a YouTube channel. Been teaching it since the first video, but you know, it's all good. Hopefully you guys are learning, especially if you learn from other people. It's all good. But ultimately, how is it that we would know to use this zone? I actually had the zone drawn out. Now let's understand why. It's true that, you know, price has moved in the structural move and has clearly shifted away from this, which means, if you've seen my other videos, that all of the prior inside lows, these lows existing here, actually should function as areas that have sell stops resting under them and should technically be targeted as we make our way into the deeper demand zones here and potentially this one here. So on one end, if you're following the large structural play of this push here, you already understand that we've ran a certain amount of sell stops and have a reason to go long from here or from a point a little bit deeper. But at the same time, remember the golden goose strategy. If you take the time to actually analyze the charts you're looking at and zoom out and in on them and find out where you are in the market, because remember, we don't use time frames for the purpose of time frames. We use time frames to see the delivery of price, to understand specifically where and when there was manipulation, inefficiency, and continuation. So if you go to the daily, very quickly the story changes. You very quickly are able to notice that there was this break of structure here, which is characterized by this high being formed, this low being formed, that low shifting and displacing to the top side quite impulsively without the regard for a liquidity grab and instead a large push. And again, if you ask yourself, where did that move come from? Your eyes should instantly go to the first manipulation, which happened here, this demand zone, which if we draw out really quickly, this is actually one of the things I said in my weekly markup with our team, is also characterized by this nice little imbalance here, thereby showing us that when, again, they pushed down into these prices and began to buy back up, and whatever buys they have ran, there's a good chance that they weren't able to close all their risk as a result of this inefficiency right here, which means, wow, I can't even draw, which means in the future, if we are to make a move back down into this area, there's a good chance that we are going to see some kind of mitigation in the form of weak to strong hands to go much longer, to go long, or we're going to see that weak to strong hands into the redistributions, which may continue short. But more likely than not, we're looking for that area to act as that place that will show us that there's going to be displacement that wants to bring us to the top side and continue running highs, because the higher time frame, the golden goose method, especially if you just zoom out like this and view where you are, the golden goose method clearly states that we have shifted our structure to the top side. And now we're probably going to want to look to either A, clear the liquidity here, here, and here, tap into the S&D points here and go long, or clear out all that liquidity, including this and this liquidity, fulfilling this imbalance, and go long from here. This is where you can have multiple S&D zones that are both valid, right? So it doesn't change their validity, but you need to understand that your confirmation and your entries and your criteria for entry is characterized by these three main things. You need to have all three in order to actually trade, right? And again, like I said, so many YouTubers now, that there's like 5 new smart money YouTubers every week now after my YouTube channel was created, and almost all of them look to teach you this. So use this information and actually utilize it. I see a lot of questions regarding, oh, I keep picking S&D zones, but they don't work. Well, are they being characterized by structure, and are you confirming them? Well, you guys have to realize, and this is something I bring up in the mentorship a lot, and in a lot of my one-on-ones. By the way, if you'd like to have some one-on-ones, make sure you join this link in the description. But the main thing I bring up is that the reality is I have S&D zones drawn out throughout the week, and I have to say that at least 60 to 80% of them fail. 60 to 80% of the zones that I have drawn on to the chart fail. The truth about smart money isn't that there's a zone that's the best zone and there's a holy grail for finding that zone. The truth is the zones exist as smart money mitigated potential areas. And your ability to confirm that and allow your rules to make you money on the Wyckoffian accumulations or distributions or your confirms, that's where the money is made. There are countless traders and countless stories of multi-million-dollar traders that do things much simpler than what we're doing here, that have, for instance, a 200 EMA and just buy and sell the 200 EMA, but manage it properly. Most of the reason that you are not being profitable is because you're not managing properly and your emotions are getting in the way, okay? So there's no such thing as the correct zone or the right zone. People that want to teach you that or want to teach you the best zones doesn't really exist. If you want to find the best zones, characterize those zones and allow them to act and form in the scenario of a structure being present. What do I mean by that? Well, let's go back to the trade that was right here. So as you can see, clearly we have this shift to the top side, this break of structure. And again, which points would we want to see mitigated? Number one is this one right here with the sells to the buys that were not mitigated as a result of this imbalance. And number two was this sell to buy, right? That again was left with an inefficiency that now needs to be mitigated. So we understand that this overall structural play can have a multitude or a number of places that can go long. What's funny is I didn't even start going long here. I started going long right here. So if we go to the 8-hour chart, this is what I was talking about last week. I went long inside of here, and this paid off very nicely. You can see this. I mean, clearly that when you confirm a move like this is an insane amount of pips and RR that you can get out of that. And like even if you look at this from a standpoint of just buying this S&D point at the 50%, as we teach on the channel, I mean, this on its own, and again, I do not enter like this at all, but this on its own round 1 to 10, and then maybe if you want to target like highs, so it's like, yeah, it's about 1 to 10 if you target it like that, or if you targeted just the high of the structure point, because this is the structure point, it's 1 to 5, and if you confirmed, this trade can get out of hand. So I was looking for that. Number two is when this break happened, I actually looked for a buy here as well, and you can see that when I got into my buys here, because I took buys in here as well, I think I had 3 break evens there. Right? And that's part of trading. This is the part that no one will tell you, no smart money YouTuber or mentor will usually tell you. But the reality of these zones is that we are all watching the zones. We are looking to get involved in our own way. And when we get involved, our management of that involvement is what's going to decide whether or not we become profitable over a long time. And it's not that I predicted the right zone. It's not that I predicted the right zone. Price could have just as easily went from here to keep running highs, and I would have been right about the zone. Price also could have came here as it did just now, and my buys can now run to the highs, in which case I picked the right zone. Or price can break down through all of this. I could pick the right zone on the move back down, look to trade that and sell into it. And as I do that, it will look like I picked the right zone here and the right zone here. And I'll look like, again, I'm scamming because I know everything about the market. The truth is, we use these points of potential mitigation to confirm our moves. That is why we teach and we relay the importance of understanding that you look for structure, you look for S&D to confirm that structure, and you look for confirmation or Wyckoff weak to strong hands within that S&D to confirm the overall move. This is how it's done in the smart money sphere. This is how YouTubers, this is how mentors can get high win rates, because they allow for this to act as that high win rate that confirms these two. They get much higher R's or pick or make it look like they pick the right zones, because after the fact, when the trade has moved from the actual zone it should have moved from, they're able to post that. And you miss and are not able to see the buys that were looked for inside of this demand zone, 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 and inside of this demand zone. Now, whichever one holds, it would look like a good trade. And guess what? It is a good trade. But you need to recognize that the process of being profitable and taking the right trades is also a process of A, following rules, 2, taking those rules in multiple areas, and 3, allowing price to do its thing until it hits basically your home run, right? I'm not buying here with the expectation that price wants to go all the way back lower, but I know that it can, which is why when I get into these buys here, that is managed really, really heavily. Similarly, when we look for buys here, we get into those buys on the expectation that, hopefully we get this to go and run to new highs. My overall target still remains this high right here on EU. Now, again, I might be fully wrong about that, but week after week, price will formulate a certain move and a certain impulse, and that impulse will be met with certain buy stops or sell stops that you're going to want to be ran. And that bias, that story, that structure behind that idea is going to formulate multiple new S&D zones, all riddled with imbalances and inefficiencies that will need to be mitigated in the future. And your job is to go and allow price to deliver to those points and then confirm it. That is where Wyckoff confirmation and weak to strong hands comes in. That's where the quote unquote, the right zone comes in. The truth is, this is the right zone, this is the right zone, and this is the right zone. But it's not going to be the right one until the actual move happens. And if this move runs here, great, we picked the right zone. But again, there's no such thing as picking the right zone. I'm trying to get this across, but it's sounding so weird. The truth is, most people that tell you can pick the right zone, or if you join their mentorship, they'll show you the best way to find the zone. It's bullshit, right? You have zones that are characterized by certain principles, and you're going to have multiple of them. And most smart money, profitable traders are looking to get involved in almost all of those zones, right? Especially if they have an underpinning of a story that surrounds it, like this right here. And when they get in on this, they don't just get in and just hope. What they do is they get in and they allow their partials and their management to do the rest. So as they're watching this go, we actually also had this zone selected here to look for sells from, and you can see the sells from there are working perfectly right now. So when they look to buy here, not only they're looking to buy here, but they're looking to break even when this starts to go bullish. They're looking to trail as it starts to go bullish. They're looking to partial at future areas of potential mitigation and liquidity, because as we understand, if there's a ton of liquidity here and price runs it, there's also a good chance that price can redistribute now to keep going short and could make its way deeper into this POI to go long. And then again, your zone is correct, or I got the right zone, or come way deeper into the zone down here, right? And then go long again. In which case, all these actual profitable smart money traders are able to buy in these areas, sell from these areas, and be dynamic with the delivery of price. There is no smart money trader that can just look at you and say, I'm bullish, I'm bearish. Like, the reality is we can trade it all. And that's the beauty of being able to learn and think this way, because you are able to take a look at where you are in price, what liquidity is being ran, how it's being ran, how price is displacing from that specific area, and how you can trade the newly formed S&D zones with confirmation from that point. The 3 steps to basically mastering smart money is understanding these 3 in this specific hierarchy, in this chain of command where structure basically comes first. And if you're able to do that on a consistent basis and record your findings or journals, you are going to begin to see success ultimately, right? And this is all perspective based again. Don't sue me, not financial advice, but go and do it for yourself. I don't care if you believe me. You don't need to buy my course or anything like that. Use my free stuff, but go and test it. Go and find specific impulses. Go and find the S&D points of those impulses that are also characterized by specific imbalances resting just above them. Watch how price mitigates that area and watch how it shifts and watch how it delivers to the next structural point and then how it delivers higher. And ask yourself how you can be a part of that move with proper risk management. This is how retail traders that trade support and resistance and trend lines make money. This is how algo traders that trade the daily Donchian channels make money. This is how 200 EMA traders make money. This is how people that use EMA fans make money. It's not the fact that their strategy is this amazing, out of the world, holy grail with the best zones and the best win rate. It's that they actually understand how their setups form and how they can manage those setups to provide them an edge over the long run. If you're looking for that quick buck, go gamble, go buy a lottery ticket and move on. The industry's not for you. This industry forces you to lock down to basically play with the emotions that you are so used to and completely change the way you think. I'll have some future like psychological videos on this stuff in the future, but it's not going to be that important right now. The main thing I want to get across to all of you is that there is no real best zone. The true best zones are actually characterized by these three main rules. And as long as those are present under your own entry criteria, you are going to be able to turn that into an edge that you can use to make money into the future, okay? And as you can see, even when you might be bullish on an overall market, you also understand that it could be bearish up until these points here from which you can be bullish again. And in the case that that's true, a lot of people, especially in the mentorship right now, were looking to sell this point here. And guess what? They were able to sell into this beautifully and now are probably partial or broken even or looking to target the liquidity here. And even if their sells are correct, my buys can still look to hold at my break evens and keep going long. So people can make money, smart money wise, on the sells and the buys in any given market if they understand the plan they're using to follow for risk management and entries. And for those worried about, this getting out and too many people being able to trade this way, stop, because that's not the case. Until you realize that the entire market ultimately is a competition against yourself and no one else, it's going to be very hard to be profitable. Okay, there's no such thing as too many people using something. There kind of is, but you shouldn't be worried about that because the way we're trading is always going to be around because it's literally the reason for the delivery of price. And unless price decides to stop doing this, okay, and starts doing this forever, smart money will always be in the market, right? So that means that if price ever did do something like this and start to just, never have any pullbacks, all you have to do is buy with a stop loss right here. And no matter how much it goes up, you'll be up 1 to 1,000 instantly. Otherwise, if you buy and let's say the composite man finally starts to liquidate you, guess what we have now? We now have an area to work with for pullbacks, for continuations, and now we're back into a market that will unfold the smart money way. So stop worrying about that. Additionally, it only takes a second for you to go to like something like Euro USD, maybe go to like a daily, and just kind of go back in time and literally just go anywhere you want. It doesn't even matter, right? Like go somewhere where there's more liquidity like this and just kind of take a look at the price. And if you follow along with price, you're going to see the same things prevalent. You're going to see the same structural moves happen that don't make their way all the way back to demand. You're going to see the same structural moves happen that do make their way back to demand. You're going to see structural moves that begin to break down, make their way to supply, keep breaking down, make their way to supply, keep breaking down, leave behind great supply zones, also characterized by an imbalance in that area, getting fulfilled, being mitigated and continuing. Then you're going to have the same thing. The new breaks of structure lower, which come from the S&D points here and the S&D points here, which then again give you new setups to keep going short. And again, on lower time frames, these moves are huge. And you can do this across any time frame, anywhere. You can go anywhere in the market, zoom in, and you're going to see this happen because this is how price delivers. You have your breaks of structure, you have your S&D points, you have the confirmation and the continuations. You have new continuations, you have new S&D points, you have the new mitigations and you have continuations. Why are these mitigations happening? Because within all these sell to buys and the lack of being able to close positions in certain areas of inefficiency, they are reclosed and continue. And basically, you know, go back in time, even on gold to like, I forget how far back it goes, like 1920, you have the same exact delivery of price occurring from areas of supply and demand, from Wyckoff happening and it working nonstop. This is why Wyckoff was able to make money like this 100 years ago. This is why things that consider consolidation and breakouts work and have worked for hundreds of years. And this is why it's never going to stop working. So stop worrying about other people using the concepts or whatever it might be. Start worrying about how your own psychology is influencing your ability to basically get involved in the market, and focus on how to make these 3 rules your own. That is ultimately the way that you will become profitable in this market. So again, off the Mitigation 2.0 talk, or the second part of this video, we have this big breakup. Again, I'm sorry I'm going off topic a lot. This is kind of going to be more of like a psychological one. If you've made it this far in this overall talk, there's a good chance that you're actually on a road to good profitability. If you stopped somewhere, you're probably fucked, because you don't want to hear the psychological end of things, which means it's just over. I got a cough, hold on. Okay, we're back. Holy shit. So if you watched it this far, you're on a really good path. And now let's talk about the actual delivery of price behind this. So price does make this break up. It has multiple areas that went down before the move up. And those areas are again characterized by that lack of being able to mitigate. Therefore, we know in the future, there's going to be mitigation that happens. This is actually what happened today. And upon that mitigation happening, or actually it was yesterday, upon that mitigation happening, you're going to get the exact same setups we've spoken about forever. The timeless transfer of weak and weak to strong hands, that strong hand liquidation of all the weak, and the new continuations higher from the points of AR, and so on and so forth. And we're not going to talk about the exact entry criteria here. Entry criteria is worked with in depth in the mentorship. If you want a piece, and if you want to take your own learning to the next level, and if you're having trouble just following the YouTube channel, check out the link in the description. Otherwise, thank you so much for watching, guys. I hope this helped you guys out. And again, I'm looking forward to seeing you guys in the next video. Also, stay tuned for the mentfx prop firm, which is coming out real soon. Thank you guys, and I'll see you guys in the next one. Bye.